Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Friends and listeners, this is James Kandasamy from Achieve Wealth Through Value-Add Real Estate Investing podcasts. As you all know, we talk all about commercial real estate. That's where the value-add through real estate investing comes in after the Achieve Wealth. And today we're going to be talking about an asset class which we have never talked about before. We have talked about multifamily as usual, right? Because that's what I do. And we talk about mobile home park, we talk about self-storage. But today we're going to be talking about single tenant net leased business, asset class and business as well. And I have Neil Wahlgren from San Francisco. Hey, Neil, say hi to everyone.
Hey guys, thanks for having me on the show today, James.
Yeah, so Neil is an expert in this asset class, and we want to go very deep into this asset class because I really want to understand how it works, how it can be a really good investment vehicle. So Neil, why not you tell our audience about yourself and what market are you focusing on as well?
Yeah, absolutely. Just some quick background. So Neil Wahlgren, I live in San Francisco, born and raised in the Bay Area here. Spent before commercial real estate. I actually had a very different chapter. Went to the Air Force Academy and ended up flying C-130 aircraft for both the Air Force and the Navy Reserve. So did that for about 10 years. While I was in, I got my MBA, and shortly thereafter got out and quickly transitioned over to mainly the capital raising equity side of commercial real estate. And the background was kind of interesting. I ended up getting connected with a family friend that had a Bay Area based equity business. And the model was they would basically partner with commercial brokers and sponsors on a deal by deal basis. And our company had a network of investors. So we would actually create the investment offering, we would raise the capital, and then our partners would be asset facing. So they would focus on, whatever commercial real estate that we were buying there. But what was neat about it was we had about 6 or 8 different partners that we worked with. And so, we had one guy who did multifamily. We had another group that did, multi-tenant retail, another one multi-tenant industrial. One guy did office. So we really got to see a lot of different asset types and get to see, different underwriting, how to structure it and see the kind of comparative risks and rewards of each asset class. And one of the groups I worked with was Mag Capital, and they strictly do single tenant net lease. And I was really drawn to both the model and the team over there, and had the opportunity about 2 years ago to fully join Mag Capital. And so now I oversee the COO and oversee everything from operations, but largely, growing our investor pool, growing our equity side. And when we do raise money, I basically oversee a small team to bring in all the investor equity in order to close on the single tenant industrial deals we do.
So let's go into deep into this single tenant net lease. So in the beginning, you were raising money for different asset classes, I guess, right? Then you were attracted to this one partner, right, or a friend or a group. Then you joined them, I guess, which does single
Correct.
tenant net lease, which is interesting. So you can compare now all the asset classes, I guess, right? So,
Yeah, I'd say I have
it.
a unique perspective, having really kind of deep dived with a bunch of these different types of asset classes, where a lot of people get kind of niched into just one early on.
Yeah. I mean, operators, like for me, I'm an operator. We need to specialize on one. Like your partner, Matt Capital, they're going to be all focusing on one, right? They can't go into multiple asset class because every asset class, in my belief, there's so much of nuances in it. There's so much of details,
Very different animals.
so much of expertise, and it's very hard for me to find someone who can do all of it and say that they are really good at each one of it, right? Because you need really strong specialization. So at very high level, since you have done multiple asset class, can you describe what is this different about single tenant, net lease um, business compared to like multifamily, self storage, or mobile home park, or other asset class that you've
Absolutely.
done?
Yeah, it's a very different look. And what I mean by that is in comparison to, say, multifamily, which you and your listeners have as specific expertise in, multifamily, really it's a combination of, having the right kinds of tenants in your buildings, but largely you're really focusing on the building itself and, doing improvements to that building that really generate increased rents and better occupancy. And the metro and the demographics are extremely important. Conversely, on industrial, especially on the single tenant net lease side, all those factors are still important, but at a much lower level. And instead, your focus goes significantly into really the quality of the lease and the quality of the tenant who's guaranteeing that lease. And so those two factors become really the cornerstone on whether that entire investment and the cash flows that come from that investment are predictable, on time, and profitable, or if you don't weigh that well, you can really find yourself in a bad spot with an empty building and having to release potentially in a non-major metro.
Got it. So when in your specialization, so when we talk about single tenant, are you talking about industrial specific, or is this retail as well?
We mainly do about 90% or so of our deals are industrial. And so
Oh,
I'll
okay,
give
got
you
it.
kind of a general tenant profile. Most what we seek out are very long-standing manufacturing tenants. Most have been in operation 40, 50, 60 years. They make core products, usually non-consumer focused. So most of these are B2B products. For example, some recent acquisitions we did included tenants in the government aerospace parts manufacturers. We did one that did high density foam end caps that are kind of custom laser cut to perfectly fit, high end electronics and appliances. We did another company down in Phoenix where the company actually was a contract manufacturer for hair and skin products. So retail brands would go to them and say, "Hey, I need 1,000 gallons of this new skin cream. Here's the formula," and this company would make it, sell to the retail facing brand who would label it and then market and sell it. So those type of B2B products. And the reason we seek that is because those kind of companies tend to be much more resilient to the highs and lows of economic cycles compared to, consumer facing industries.
Got it, got it. So just to clarify for the listeners, a B2B means business to business, which is a distinction between B2C, right? Which is business to customers directly, right? So you guys do more on the business to business. So there's no retail customers involved, right? So
Absolutely.
yeah. So okay. So let's go into deeper into this single tenant net lease. Okay. So why single tenant? Why not multi-tenant industrial building?
Yeah, and to be honest, a lot of people tend to shy away from that at first, because they view, especially coming from the multifamily side, you view, hey, if I have multiple tenants, I can afford to lose a few and still have my overall NOI, can cover debt service, and I can still have a profitable investment. And sometimes that concentrated risk of a single tenant can sound a little scary. Instead, we look at it really that it is a concentrated risk, but if you understand the creditworthiness of that tenant and understand it well, then suddenly you have a very reliable set of cash flows that are coming from that tenant and the lease tied with it. And ultimately, we have a specialty in that we've built a team in-house. We call it our credit advisory team, where every time we go into a deal, they actually, not only are they building the investment summary that's similar for most investment real estate offerings, but we also create a credit memo, and that credit memo is going to deep dive into all really a kind of a hybrid of not just the real estate, but also what, for example, private equity groups might look for. And we're looking for financial ratios, EBITDA margins, how much long-term debt they have, and then to take it a step further. Most of our acquisition deal flow comes through what's called a sale leaseback. And sale leasebacks are really well suited for single tenant deals. And ultimately, we will come in and we usually will buy a piece of property from an owner occupant. So typically a manufacturing company that also owns their own real estate. and they will look and they use a sale leaseback really as kind of a refinancing tool. And they're able to free up the capital that's tied up in the real estate, and they sell us the building, and then simultaneously they turn around and sign a brand new 20-year full triple net lease. And that basically it's a win-win. So they're getting a big influx of cash that they use typically to grow the business or reinvest in ways that are more profitable than owning real estate for them. And then for us, we're getting a very securitized set of cash flow that we're able to start paying out to investors from day one, and ultimately have a lot of protections in that we don't have to cover any expenses. And that's part of that triple net structure.
Yeah. I mean, just to clarify to the listener, sale leaseback is basically a strategy used in commercial real estate where people who are not a real estate investor has been owning real estate, and now they figured out, oh, this is too much for us. We don't really want to be in the real estate business. They just want the space, I guess, right? Then they said, someone come and buy my real estate, but I want to lease it back, so they don't lose the location, right? So, but you are right. I mean, they get the benefit of getting a long-term lease plus the original location they were in, whereas real estate investor get some kind of what you call the cash flow because they have somebody who's leasing who's a high credit worthiness lease. I mean, tenant who's already been there for a long time, who's not going to go anywhere. So it's a win-win. That's what you mentioned. That's a really good explanation there. So I just want to clarify that because maybe it's for my own understanding as well.
Sure.
But I think I know some of it, right? So coming back to single tenant sale leaseback deals, right? How do you find them?
Yeah, so I would say our average deal that we end up being able to bring to our investors typically comes from a manufacturing company, and usually it will be owned or recently owned by the founder. So imagine a man or woman started this manufacturing company maybe 40 years ago. They've grown it, they've reached retirement age, and they're looking for their exit. So they typically will sell to a private equity group. And usually, there's a lot of boutique, smaller private equity groups that really niche down on a certain type of manufacturing company. And they will come in and they'll buy the company. And usually that comes with the real estate. Now, these private equity groups, they're able to see much higher returns in investing in the company than they can in owning that real estate. So that's their driver for why they want to sell us the real estate. So they come to us, or they go through their broker who comes to us. Almost all of them are off market, because the people that negotiate and can actually do full cycle sale leasebacks, it's a fairly small community. It's much different than buying a listed property on LoopNet, that has an existing lease, and really you're just buying the property. So instead, once we connect, we're negotiating with them we have two main levers. So the first is, what kind of net proceeds do they want? So we can see, all right, how much are we willing to pay for the real estate? And then the second piece is, what are the terms that we're going to lease it back to them for? So you can kind of move those together. So, hey, if you want to maximize proceeds, I'll buy it for maybe a little higher end of the market, but I'll rent it back at a higher price per square foot. Conversely, if they want a lower price per square foot on the rent ongoing, then maybe they'll sell it to me for a relatively lower price. So we have a little bit of wiggle room, and it's a bit of an art form there. But once you land on it, then they still maintain full control of the property, in that they are responsible for all the expenses, but they can do improvements and really operate that building fully in the same way they were before that sale leaseback. And that's attractive to a lot of industrial owners who become tenants in that structure.
Yeah, and they do get some kind of tax benefit as well, right? Because now they become renters, so it's going to be minus stuff from their books, I guess, as an expense.
Yeah.
Right?
So from a financial level, there's really two reasons why you would do this versus mortgage. So you can pull out 100% of the proceeds of the value of the real estate through a sale leaseback. Whereas if you buy or own, typically you're only able to pull out about 60 to 70%. And then the second piece is you're able to write off 100% of your rent payments, whereas the mortgage interest ends up being capped at a certain percentage of your EBITDA. And so there's, especially with the new tax laws, it's actually favored. It's much more beneficial from a tax perspective, to pay rent than it is to own and pay interest.
Correct. Yeah. So there are the people who doesn't want to be in the real estate business, right? But they still want to own the business, right? But
Correct.
and they still want the location, so they get the benefit of the rent paid as an expense, and they get to reduce from their tax liability, I would say, right? So that's
Absolutely.
good. So I mean, industrial has been doing very well. I mean, in fact, I think that is the biggest beneficiary of this whole COVID thing, right? Because
Yeah.
everything's moving online, right? So is that something that your company has been focusing recently, or they have been doing it for a very long time?
We've been doing single tenant stuff for really since inception. So Mad
Okay.
Capital was founded in early 2015.
Mhm.
The two founders, Dax and Andrew. Dax was a commercial real estate broker for about 15 years prior,
Mhm.
and so was brokering deals, and then started buying his own, and then setting up small investment groups, and formally started doing kind of our syndication model in 2015.
Mhm.
And then Andrew is full CCIM. He's also a MAI, commercial real estate appraiser by trade. So he's really our valuation expert. So those two pieces are really necessary for the negotiations that go on to be able to negotiate price and the terms of the lease, such that we're able to get good fundamentals of the real estate in the unlikely event that our tenant did default on a lease there, such that we had to re-tenant it.
So tell me about what are the high level criteria of looking at a deal. What is the year build? How many square feet do you guys look
Sure.
at? What kind of credit worthiness, or how long the tenant need to be in that deal? And
Yeah, absolutely. So it's funny. Really, the age and the quality of the building are much lower on the list of things to look at. The real estate, they're not fancy buildings. They're metal sided, flat roofed, usually in somewhat tertiary locations. Some are a little more primary, but a lot of times, we will weigh and say, hey, we're willing to buy a building that's maybe a little bit farther out of a major metro, because the quality of that tenant is, higher than maybe the alternative. So, we're tenant focused first. And when we look at tenants, there's a spread of type of really tenant and credit risk that an investor can look at. So just to use an example, on one side of the spectrum, you might hear sometimes people will own a Walgreens, for example, and those are going to be, very safe, right? Walgreens isn't going anywhere, and they have tons of locations. However, you're going to have to buy that at a very low cap rate, just because the strength of the credit for Walgreens, because it has an outside credit agency, Moody's or S&P, give Walgreens a credit report. And so because of that, you're not able to extract a lot of value out of that Walgreens. It's very consistent. So you might only get, 3-4% cash flow if you're lucky. But it's going to be dependable. So a lot of institutions, a lot of, pension funds, life insurance groups, they'll invest in those type of triple net deals. What we play in is what's called below investment grade. So typically, any company with above $100 million a year in revenue will have an outside credit agency give them a credit report. For us, we play in that sub $100 million a year revenue level. And what that means is there's no outside agencies doing this. So we actually create our own, our own credit reports for these companies. We deep dive, we look at it, we analyze the ratios. The guy heading our team actually was formerly head of credit analysis for Store Capital, which is a large publicly traded REIT. So he knows exactly what to look for in terms of, what are the key components on how sure are we? Really, the bet is, how sure are you that this business is going to be viable over the 5 years that you plan on holding the real estate, and that they're going to pay their rent payments on time? So that's what we look at. And because it's in that sub-investment grade space, we're able to capture, in our opinion, additional value. And really that value comes from the arbitrage between real and perceived risk. So there's a perceived risk that smaller companies just are naturally riskier. But when you deep dive and actually look at them, sometimes you see these are actually much more profitable companies than a lot of publicly traded ones. They have lower debt. They're often, family owned. They've focused on core business fundamentals as opposed to just bolster their stock price. And when you deep dive into it, really you can get a great handle on, hey, what is the true risk of this? And this has been evidenced. It's one thing to talk about this, but a track record speaks better. And in our 6-year history here, we've never lost a tenant. We've never had a missed rent payment across our entire portfolio. And on average, we've been able to deliver high teens returns to our investors on an annualized basis.
Got it. Got it. Um, there's so much of details there. I wanna piece it into small. So you look at their balance sheet, how their credit worthiness. I mean, I'm sure there's a lot of details there, right? I mean, it's going to be
Of
very
course.
difficult, but I'm sure you look at what are the core products they do. Have they been on business for a very long time? Maybe it's a family-owned business, not going to go anywhere, I guess, right? And sometimes the product is so core, it's not going to go anywhere, right? So
Yeah.
so that are the things you would look for, I guess. Okay. Okay. Got it. Got it. And what are the markets you look for this kind of deals?
So in terms of where we buy,
Mm-hmm.
most is in some of the South. We have Texas there, and then also the Midwest, so
Mm-hmm.
Oklahoma, Nebraska, Iowa, Indiana, Michigan, and really that kind of central corridor in the U.S. makes sense on twofold. One, you're able to get more attractive cap rates, so really
Mm-hmm.
more dollars of NOI generated for every dollar of real estate you spend. And then the other piece is just from a manufacturing basis, being centrally located in the US tends to make the most sense for these companies who are distributing and shipping nationwide.
So what is the cap rate that you guys target at, or what is the industrial single tenant market cap
Yeah.
rate?
Nationwide, they're trading at about low sixes.
Mm-hmm.
We typically will buy either a little more tertiary or sometimes, a little smaller credit profile of a tenant than, some of the larger institutions are. So we typically target, maybe 7.25% to 8% cap rates. And that's been our sweet spot range for putting together these acquisitions.
So how do you get financing?
Yeah, so our typical capital stack, we're going to usually get our debt from local real estate lenders. So typically credit unions or local banks, almost always in the state of the real estate that we're buying. And for whatever reason, we find they're just more comfortable with the areas. They're more comfortable with the companies, oftentimes in their own communities. And we're able to get better interest rates and better leverage on those
Mm-hmm.
type of offerings.
Mm-hmm.
So we usually take on about 70% loan to value in terms of real estate debt. And then the remaining balance, the 30%, will raise from investor equity and co-invest as a company. So we typically target about a 15% co-invest of total equity.
Okay. So what is the usual right now, if you go and buy today, let's say you get 70% leverage, what are the rates do you get? And is it recourse, non-recourse? What is the amortization schedule usually?
Yeah, no, great question. So these are always going to be a little different than your, Fannie and Freddie
Oh yeah,
loans,
forget
than
about multifamily
multifamily.
financing. You can't
Oh.
beat them, right? So
No, it's true. It's true. So, when I started this about 3 years ago, we were getting a lot of 4.5%, 4.75%. But really, it's been driving down as the credit markets have loosened and interest rates have really driven to the bottom. So our last few acquisitions have been low threes, which
Mhm,
for the industrial space is fantastic.
mhm.
They're almost always recourse, and so our sponsors, or excuse me, the principals of Mag Capital will sign personal guarantees on the real estate debt. And also, like I said, heavily co-invested. So it is a little different on that side, but from an investor's standpoint, typically we see that as a net advantage because you have a sponsor that's much more, fully vested in this deal, has a lot more to lose if the deal goes south. And frankly, it's just more inclined to make sure that they do what it takes to keep the deal afloat if it ever
Yeah.
hits issues.
How big are these deals? Let's say one deal usually, what is the price? What is the total price range usually?
Yeah, so we play in that middle market space. So
Mhm,
largely, everything 5 mil and below is kind of reserved for the individual buyers, individual investors. Typically above 25 mil, you start getting a lot of competition from, institutions, large REITs, people with large checks to place. And so we typically play about 8 to 20 million as our sweet spot for total acquisition size. And that
mhm.
usually correlates to roughly 2 to 5.5 million in equity per project. And so, and we don't run a fund. The way we structure ours are, direct placement, deal by deal basis for each project.
Got it. Got it. Got it. And how frequent do you guys do deals?
Last year we did, I think 9. So it was actually, we were, COVID was a little wild, in
Mm-hmm.
March and April timeframe, but the asset class really just proved to be, comparatively one of the most resilient in the commercial real estate space. And this year, really the whole concept of the transactional structure of a sale leaseback is kind of gaining momentum and acceptance. So we're seeing really a lot of folks that have held real estate for a long time and are seeing, hey, this is a way to kind of, continue to grow our companies.
Mm-hmm.
So I think we're probably going to look at, between 8 to 10 projects this year that we do as a company.
Got it. So you target below $100 million in credit worthiness of the tenant, right? That's what you look at. I mean, not credit worthiness, their I don't know,
But
the
gross
balance,
revenue.
gross revenue. Okay, got it. And you look for like 8 to 20 million, because anything above 20 million is institutional grade, I guess, right? Below 5
Yeah.
million is individual buyer, right? So
Yep.
is there something new that was brought into syndication? I mean, how were the owners doing it before you guys were syndicating these deals?
Yeah, I mean, typically it was either individual or, kind of what we call JV, where you get
Mm-hmm.
a handful of investors who are all managers on the deal as well.
Mm-hmm.
But, now we strictly do syndications where, our group takes the GP manager liability side, and then our investors are fully passive. So as a result of that, we've slightly tweaked our structure a little bit, and it's really, it's cash flow first. So
Got it.
our standard is, a deal should be able to pay out from day one a minimum of 8%. Some projects will even start at 9, and then with these leases, we actually build in from day one. We build in annual rent bumps, so it's all taken care of from the day that we close on the purchase. And most of these leases have 2% rent increases per year, and because there's no expenses, that 2% directly correlates to 2% increases in NOI, which directly goes to investors.
Got it. And what is the average, return of a deal? I mean, do you guys look at 5 years return
Yeah,
as well?
when we sell, and that's not an arbitrary number. The reason we like to focus on, roughly 5 is because when we're signing new leases with
Mm-hmm.
these sale leasebacks, typically you're able to get a new term of about 15 to 20 years. And so
Mm-hmm.
what that means is after 5 years, you have 10 to 15 years left on the lease. And that in that scenario, there's enough meat on the bone where that's still a very attractive sale to the next, yield focused buyer. And we're typically selling to, individual buyers, 1031 exchangers, some small, kind of boutique REITs, and also other private investment groups. And so because of that, we like it because we never have to, go through a releasing risk. The whole end of lease,
Mm-hmm.
dog and pony show.
Yeah.
Maybe they lease, maybe they release, maybe they don't. Maybe they're going to have, special terms. Maybe I have to, pump a bunch of money in to kind of coax them to do this. So we really kind of push that operational risk piece down to the next buyer, and so that's why we limit our holds to about 4 to 5 years.
So let me understand correctly. So the lease that is signed is 10 to 15 years, right?
No, usually 15 to 20.
15 to 20. So that's when you guys, usually when you buy it, you already have that 15 to 20, usually, right? That's the best case scenario, I guess. Banks love that because now you have a long-term lease, right?
Well, and it's one of the advantages of having the skill set to do a sale leaseback is you are the first owner and you get to pen that lease for as long as you're able to negotiate with the seller.
Oh, got it. So basically after 5 years, you just see that, okay, we have made enough money for us and our investors. Now the next buyer have another 10 more years or something like that, right? So which is a really good, because usually what I see in the commercial, like, triple nets are like, if you put 5 years and the lease are 5 years, you basically, your value is depreciating, right? At the end of 5 years, because now everybody's supposed to be leaving. You can't even sell, right? So
Exactly, yeah. And we're able to grow value and typically generate a decent amount of profits historically. And sometimes people are confused on this and they go, hey, if you're not doing any major value add, because they, kind of used to say a more multifamily mentality where you put new countertops and new paint on. The way we create value really is twofold. So one is we're paying down principal on the real estate debt every month. And then the second piece, which is the main piece, is because there's no expenses, those 2% annual rent bumps directly correlate to a 2% per year increase in NOI. So we're seeing, after 5 years, we've seen, a little over 10% increase in NOI. So even with a consistent cap rate, you've seen fairly substantial increase there in value. And really those are the two main pieces. And then the third piece that we've been fortunate on, certainly not a guarantee, but if if your tenant grows in the way that that private equity group that just bought them wants them to grow, you can find yourself with substantial, what they call credit enhancement. So imagine, if you own two buildings and one has, a small mom and pop tenant and the other one has a massive national tenant, clearly you're going to pay more for the latter one there. And so if we're buying real estate with, say, a decent credit tenant, but maybe the revenues are 30 million a year, and maybe 5 years from now, maybe they've quadrupled that and they're doing 120 million a year. We actually just had a deal with similar numbers there. That's substantial credit enhancement, and now you're able to typically sell at a much lower cap rate to the next buyer because of that additional security that you've added through a stronger tenant.
Got it. But you are doing a sale leaseback on a single tenant, right? So the tenant is the same. So you may not get that upside on that kind of structure, right?
Correct. Yeah. So you're buying, you look at the credit from day one of what that tenant looks like. And really, if that tenant continues to grow just, organically amongst their own business, if they're able to continue to grow over the next few years, like they hope to typically, then that's a win-win for both them and for you as the real estate holder.
Got it. And how does credit worthiness increases for a tenant throughout the years? What
it can be just everything. The main factors people will look at are, low debt. They look at gross revenues, and they look at EBITDA. And not just EBITDA, but EBITDA margins. Are these guys profitable on a day-to-day, year-to-year, continual basis? And really, that's if they're able to demonstrate that and demonstrate year-over-year growth. Now they're a great target to get acquired by a bigger private equity firm, or, just kind of lever up in that way. The bigger fish that swallow those tenants, you're still the landlord, and you end up seeing carryover benefit in terms of a stronger, credit behind that tenant now.
Got it. So I think, I don't know, my understanding is from what I'm hearing from you, the biggest unique value proposition that, you and your company have is basically you're targeting a sale leaseback strategy, right? At the same time, you're targeting industrial, right? Which gives you these two advantage, I guess, right? Compared to a medical office, we can do the same thing over there, but of course you have to find a sales leaseback, and if you do that, then you can control the lease, I guess, right? And also, the industrial is doing pretty well right now, so that's a good thing, I guess. So okay, awesome. So all right, so you have any? Why not you tell our audience how to get in touch with you and about your, about your website of your companies and all that?
Yeah, absolutely. So Neil Wahlgren with MAG Capital Partners, MAG. You can find us on the web, magcp.com, or you can just email directly, Neil, Neil, at magcp.com. And most of our investments are structured under 506B. So we need to have establish a relationship before we can share our offerings. So, but just reach out. We'll have an intro call with myself or someone on the team, and then kind of go through the process and any questions you might have.
Awesome. All right, Neil, thanks for coming on the show. I think, it was really good to deep dive into the net single tenant net lease industrial. So
absolutely.
Awesome.
Thanks for having me, James. Really enjoyed it.
Thank you.
All right, take care.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.